Strategic risk management is essential for integrating risk assessment with financial planning. This course provides a framework to identify, assess, and mitigate financial risks, ensuring resilience and goal achievement. Tailored strategies will be developed for both personal and organizational financial well being, offering a proactive approach to financial security. In Module 1, we delve into the foundations of financial planning, focusing on systematic goal setting and structured financial approaches. Master the comprehensive financial planning process, smart goal setting frameworks, and time value of money fundamentals. Explore budgeting strategies and cash flow optimization techniques to ensure long term success in personal and business financial planning. Establish a strong foundation in financial planning by mastering the comprehensive planning process and its core components. Learn to set SMART goals for personal and business objectives, understand the time value of money, and apply practical budgeting strategies. Optimize cash flow to ensure long term financial success and stability. Financial planning is a systematic process to manage resources and achieve life goals. It integrates budgeting, investment, tax, retirement, and estate planning. The six-step process includes relationship building, data gathering, analysis, recommendations, implementation, and monitoring. Benefits include clarity, reduced stress, better decisions, wealth growth, and financial security, ensuring sustainable growth for organizations. Understanding financial statements is crucial for assessing financial health. The income statement, or cash flow statement, tracks income and expenses, revealing spending patterns. The balance sheet lists assets and liabilities, showing net worth. The statement of net worth calculates total assets minus liabilities, indicating wealth building effectiveness and necessary adjustments. The SMART framework is essential for effective financial planning. It ensures goals are specific, like saving $15,000 for a house deposit, measurable with clear criteria for tracking, achievable balancing ambition with realism, relevant aligning with life objectives, and time-bound with deadlines to ensure commitment. This structured approach enhances goal achievement. Financial objectives span short, medium, and long-term horizons. Short-term goals focus on building an emergency fund and reducing debt. Medium-term goals include saving for a house deposit or vehicle purchase. Long-term goals prioritize retirement planning and wealth transfer. Prioritizing these objectives ensures a balanced approach to financial security and future aspirations. Financial planning evolves with life stages. Early career focuses on debt management and retirement savings. Family formation requires life insurance and education savings. Peak earning years emphasize maximizing retirement contributions and tax efficiency. Pre-retirement shifts to risk reduction and income planning. Retirement centers on income distribution and estate planning, ensuring sustainability and legacy fulfillment. The time value of money, TVM, is crucial in finance, emphasizing that money today is more valuable than the same amount in the future due to earning potential. Compounding illustrates this as a $10,000 investment at 7% grows significantly over decades. Present and future value calculations aid in comparing investments and planning finances, while annuities help evaluate regular payment streams. Time value of money, TVM principles are vital for financial decisions. In savings, TVM calculations determine monthly contributions needed for retirement goals. For investments, TVM enables comparison of opportunities with varying timeframes and returns. In debt management, it clarifies borrowing costs and highlights the advantages of early loan repayment. A well-constructed budget is essential for financial success, guiding your financial journey. Track income and categorize expenses into fixed and variable. Use the 50-30-20 rule: 50% for needs, 30% for wants, 20% for savings and debt. Review quarterly, use budgeting tools, and optimize cash flow by increasing income and reducing expenses. An emergency fund is crucial for financial stability, protecting against job loss, medical emergencies, or unexpected expenses. Calculate 3 to 6 months of essential expenses, more if income is variable. Use accessible low-risk accounts like high-yield savings. Start with 1,000, automate contributions, and replenish after use. Regularly review and adjust your target amount. Financial risk encompasses various types, each impacting personal and business contexts. Key risks include market, credit, liquidity, operational, and strategic. Recognizing these risks helps in developing strategies to mitigate them. Understanding the interplay between risk and return is crucial for informed financial decisions, ensuring stability and resilience in financial systems. Financial risk encompasses market, credit, liquidity, operational, strategic, and reputational risks. Market risk involves investment value declines due to economic or political changes. Credit risk arises from borrowers failing obligations. Liquidity risk is the inability to convert assets to cash. Operational risk includes process failures. Strategic risk involves poor business strategies. Reputational risk affects public perception. Effective management requires diversification, credit analysis, emergency reserves, internal controls, strategic reviews, and ethical practices. Individuals face personal financial risks that can disrupt plans. Income loss risk from job loss or reduced earning capacity can be mitigated with insurance and diverse income streams. Health and disability risks require critical illness cover and healthy habits. Longevity risk demands retirement planning and annuities. Liability risk necessitates comprehensive insurance and asset protection. The risk-return relationship is fundamental in finance. Cash and savings offer low risk but erode purchasing power. Bonds provide stability with modest returns. Property offers growth but is illiquid. Equities yield strong returns with volatility. Alternative investments carry high risk and potential returns. Diversification optimizes risk return, balancing exposure across asset classes and geographies. Qualitative risk assessment offers a structured approach when precise data is unavailable. By categorizing risks based on likelihood and impact, a risk matrix visually prioritizes them. High likelihood, high impact risks require immediate attention. Evaluate probability using categories like rare or likely, and assess impact across financial, health, and quality of life dimensions. Develop narratives to make risks tangible. Qualitative risk assessment offers a structured method for evaluating risks without precise data. The risk matrix plots risks by likelihood and impact, highlighting those needing urgent action. Likelihood is assessed using categories like rare or likely, while impact considers financial, health, and quality of life effects. Risk narratives describe potential scenarios, revealing interconnected risks. Quantitative risk analysis leverages numerical data for precise risk measurement, aiding financial modeling. Key techniques include probability distributions for outcome likelihoods, value at risk for potential loss estimation, scenario analysis for resilience testing, and Monte Carlo simulations for complex projections. These methods are crucial for investment, retirement, and insurance evaluations, contingent on quality data and assumptions. Building a personal risk profile involves assessing risk tolerance, capacity, and requirements. Risk tolerance is your comfort with uncertainty, while risk capacity is your financial ability to absorb losses. Risk requirement is the risk needed to meet goals. Time horizon affects risk levels, with longer horizons allowing recovery from setbacks. Balancing these elements is crucial for effective financial planning. Risk management involves understanding risk, uncertainty, and opportunity in strategic planning. Effective methodologies for risk identification and evaluation include both quantitative and qualitative techniques. Developing strategies for risk mitigation, control, and transfer is crucial, with insurance and integrated financial planning playing key roles. Aligning risk management with organizational objectives fosters a proactive approach to threats and opportunities. Understanding risk, uncertainty, and opportunity is crucial in strategic planning. Master effective risk identification and evaluation using both quantitative and qualitative techniques. Develop strategies for risk mitigation, control, and transfer, emphasizing insurance and integrated financial planning. Align risk management with organizational objectives to proactively address threats and opportunities. Risk management principles encompass personal exposures and enterprise risk management. Understanding the risk process involves defining risk, identifying potential threats, and categorizing them into financial and non-financial types. This foundational knowledge is crucial for individuals and organizations to effectively manage risks and make informed decisions. Risk involves measurable possibilities of loss with quantifiable probabilities. Uncertainty arises when outcomes can't be predicted due to lack of data. Opportunity is the potential for positive outcomes from calculated risks. Distinguishing these is vital for crafting effective management strategies and informed financial decisions in complex environments. Systematic risk impacts all investments due to factors like economic recessions and cannot be diversified away. Unsystematic risk is specific to companies or sectors and can be mitigated through diversification. Pure risk involves only potential loss, such as property damage, while speculative risk includes potential for loss, no change, or gain, as seen in investments. Market risk involves potential losses from fluctuations in equity, interest rates, foreign exchange, and commodities, necessitating vigilant monitoring and hedging. Credit risk arises when borrowers fail to meet obligations, covering default, downgrade, and settlement risks. Liquidity risk concerns the inability to meet short term obligations or convert assets without loss. Operational risk stems from internal failures or external events, including fraud and compliance breaches. Strategic risk involves threats to long term objectives due to poor decisions or market positioning. Reputational risk affects stakeholder trust, impacting brand value and customer loyalty. Compliance risk arises from failing to adhere to laws, leading to penalties. Cyber risk involves threats to data integrity and digital infrastructure from cyber attacks and technology failures. Effective risk management involves a structured, repeatable process, identifying, assessing, and responding to threats while seizing opportunities. This cyclical framework, comprising review, monitor, mitigate, assess, and identify phases, ensures continuous improvement and adaptation to emerging and evolving risks, forming a comprehensive risk management system. Risk identification employs structured approaches like brainstorming sessions, risk checklists, and scenario analysis. These methods engage stakeholders in creative discussions, ensure systematic coverage, and explore what if scenarios. Analytical frameworks such as SWOT, strengths, weaknesses, opportunities, and threats, and PESTLE, political, economic, social, technological, legal, and environmental. Analyses help identify internal vulnerabilities and external risks by examining various factors, ensuring comprehensive risk identification. Risk assessment methodologies encompass qualitative and quantitative approaches. Qualitative methods use subjective judgment and descriptive scales, ideal for rapid assessment and emerging risks. Quantitative methods employ numerical analysis, such as Monte Carlo simulations and value at risk calculations, providing precise data-driven insights crucial for financial planning and regulatory compliance. Evaluating risk involves analyzing probability and impact. Probability assessment uses historical data, expert judgment, and statistical methods to estimate risk likelihood. Impact evaluation considers financial, operational, and reputational consequences. By combining these, a risk score is generated, aiding in prioritization and resource allocation, ensuring focus on critical exposures and informed decision-making. Risk appetite defines the overall risk level an organization is willing to accept to achieve strategic goals, setting a broad tone for risk-taking. In contrast, risk tolerance specifies measurable thresholds for acceptable outcome variations, guiding daily decisions. Clear documentation and regular reviews ensure alignment with strategic objectives while safeguarding against unacceptable losses. Enterprise Risk Management, offers a holistic framework, integrating risk management across all organizational levels. It aligns with strategic planning, ensuring risks are identified, assessed, and prioritized consistently. Coordinated response and mitigation strategies are implemented, with continuous monitoring and transparent reporting to stakeholders, fostering enterprise-wide risk awareness and coordination. Effective enterprise risk management enhances decision-making with integrated risk insights, improves resource allocation, and strengthens regulatory compliance. It fosters resilience and stakeholder trust. Key components include a robust risk governance structure, a common risk language, an integrated risk framework, and a risk-aware culture, ensuring consistent communication and strategic alignment across the organization. Individuals face significant personal risks that can impact financial security and quality of life. Health risks, such as illness and medical expenses, can deplete savings. Disability may lead to income loss, requiring long-term support. Premature death affects dependents' financial security. Property loss and liability exposure can result in substantial claims, necessitating comprehensive financial planning. Insurance serves as a vital risk transfer mechanism, allowing individuals to shift personal risks to specialized institutions. By paying regular premiums, one can replace uncertain catastrophic losses with predictable costs. Key steps include identifying risks, evaluating coverage needs, selecting suitable policies, and regularly reviewing them. This approach, combined with emergency funds and diversification, ensures financial resilience. Life insurance ensures financial security for dependents by replacing lost income. Health insurance covers medical expenses, safeguarding against high healthcare costs. Disability insurance maintains income during recovery from illness or injury. Property insurance protects assets like homes and vehicles. Liability insurance shields personal assets from legal claims. Long-term care insurance preserves retirement savings by covering extended care costs. Integrating risk management with financial planning ensures your strategies align with life priorities, safeguarding wealth through insurance and diversification. Establish income continuity with emergency reserves and insurance, maintaining cash flow during disruptions. Balance risk and return by aligning investment strategies with your risk tolerance, ensuring appropriate returns for your financial goals. Begin by conducting a comprehensive risk assessment to identify significant risks. Prioritize these based on their impact and likelihood, focusing on high probability, high impact threats. Develop specific mitigation strategies such as insurance and diversification. Implement and document your approach, maintaining clear records. Regularly monitor, review, and adapt your strategies to ensure ongoing effectiveness. This module has provided essential risk management principles crucial for effective financial planning. Key takeaways include understanding risk, uncertainty, and opportunity, and the importance of systematic processes for threat identification. Enterprise risk management offers a holistic framework, while personal risks can be managed through insurance. These foundations prepare you for advanced strategies in investment, retirement, and wealth management. Explore risk response frameworks by mastering avoidance, reduction, transfer, and acceptance strategies. Understand when to apply each based on probability and impact assessments. Delve into insurance as a key risk transfer mechanism, evaluating coverage options for personal and business contexts to ensure adequate protection without overinsuring. Mastering risk response frameworks involves understanding avoidance, reduction, transfer, and acceptance strategies. Each approach is applied based on risk probability and impact. Insurance serves as a key risk transfer tool, requiring evaluation of coverage options. Investment protections through diversification and asset allocation manage portfolio risk, while effective debt management and credit risk mitigation enhance financial health. Every risk demands a strategic response, tailored to its probability, impact, and the organization's risk appetite. Avoidance eliminates risk by not engaging in risky activities. Reduction involves controls to decrease risk probability or impact. Transfer shifts risk to another party via insurance or contracts. Acceptance retains risk when mitigation costs outweigh potential losses. Risk avoidance involves opting out of activities with unacceptable risk levels. This conservative strategy may mean missing opportunities. Practical examples include avoiding high-risk markets, steering clear of non-core investments, halting expansion during economic uncertainty, and refusing credit to unreliable customers. It's crucial when potential losses outweigh gains or better opportunities exist. Risk reduction focuses on minimizing risk probability and impact. Implement robust controls, staff training, and safety systems to lower occurrence chances. For impact reduction, develop continuity plans, maintain reserves, and diversify suppliers. These strategies address root causes, enabling organizations to seize opportunities while managing risks effectively. Risk transfer involves sharing financial burdens through insurance, contracts, and financial instruments. Insurance shifts financial consequences to providers, while contractual transfer reallocates responsibilities in vendor relationships. Financial instruments, like derivatives, manage market risks. It's crucial to ensure the receiving party can handle the risk and to account for any residual risks that remain. Risk acceptance is a strategic choice when mitigation costs outweigh potential losses or risks are within tolerance levels. Active acceptance involves deliberate retention with contingency plans, while passive acceptance occurs by default, often due to oversight. Regular reviews are crucial as changes in the business environment may necessitate alternative strategies. Insurance is a key risk transfer tool, pooling risks to absorb individual losses for premium payments. The principle of indemnity ensures compensation restores financial status pre-loss. Insurable interest requires a legitimate financial stake in the insured item. Utmost good faith mandates honest disclosure of all material facts by both parties. Life insurance ensures financial security for dependents, with term life offering pure protection and whole life accumulating cash value. Health insurance manages medical expenses, available through private, employer, or government plans. Disability insurance replaces income during work-preventing conditions, while long-term care covers extended services, crucial as life expectancy and care costs rise. Homeowners insurance safeguards your dwelling, personal property, and offers liability coverage against perils like fire and theft. It includes dwelling coverage for repairs, personal property protection, and liability for injuries. Motor insurance, often mandatory, covers third-party liability, collision, and comprehensive protection. Regular policy reviews ensure adequate coverage, especially after life changes like renovations or acquiring valuables. Business insurance is crucial for safeguarding assets and operations. Property insurance covers physical assets against perils like fire and theft. Liability coverage protects against injury and negligence claims. Business interruption insurance ensures income continuity during disruptions. Key person insurance mitigates financial loss from the absence of essential personnel, aiding in recruitment and training during transitions. Evaluating insurance needs involves assessing exposure by identifying assets, liabilities, and potential loss scenarios. Determine coverage levels by calculating replacement costs and considering deductibles. Compare policies by reviewing quotes, coverage details, and insurer reputation. Regularly review and adjust policies, especially after major life or business changes, to ensure optimal protection. Investment portfolios encounter market, interest rate, inflation, and liquidity risks. Effective risk management balances return objectives with risk tolerance, using diversification as a key strategy. Asset allocation aligns holdings with risk-return goals, while ongoing monitoring ensures adjustments to exposures, fostering resilience against market volatility and supporting long-term growth. Diversification is essential in managing portfolio risk by spreading investments across various assets, sectors, and geographies. It mitigates unsystematic risk, ensuring poor performance in one area doesn't impact the entire portfolio. However, it cannot eliminate systematic market risk, as correlations rise during market crashes, diminishing its effectiveness when needed most. Asset allocation is crucial, influencing over 90% of portfolio performance. Key factors include time horizon, risk tolerance, return requirements, liquidity needs, and tax situation. Sample models: aggressive growth, 80% equities, 20% bonds; balanced growth, 60% equities, 40% bonds; and conservative income, 40% equities, 60% bonds. Correlation measures how assets move relative to each other, crucial for diversification. Positive correlation offers limited diversification, as seen with domestic equities and property. Zero correlation, like equities and commodities, provides better diversification. Negative correlation, such as bonds rising when equities fall, offers excellent diversification. However, during market stress, correlations can increase, reducing diversification benefits. Hedging uses derivatives to mitigate potential losses. Futures contracts lock in prices, aiding commodity producers and importers. Options contracts offer rights to buy or sell, providing asymmetric protection. Put options guard against declines, while call options secure purchase prices. Protective collars combine both for cost-effective hedging. Note: futures need margin accounts, and options involve premium costs and time decay. Effective debt management is vital for financial stability. Calculate debt-to-income ratios and interest costs to assess your current position. Prioritize high-interest debt and explore consolidation. Implement borrowing policies to control spending. Regularly review and adjust strategies to maintain healthy credit utilization and repayment capacity, ensuring resilience against economic fluctuations. Credit scores ranging from 300 to 850 reflect creditworthiness, influencing loan approvals, interest rates, insurance premiums, and more. Improving scores can significantly reduce interest costs. Key strategies include timely payments, maintaining low credit utilization, keeping old accounts open, and limiting credit inquiries. Even a 50-point increase can lower mortgage rates by 0.25% Reducing debt effectively involves strategic approaches like the debt avalanche and debt snowball methods. The avalanche method targets high interest debts first, saving money but lacking immediate psychological rewards. Conversely, the snowball method focuses on paying off smaller debts first, boosting motivation. Additional strategies include negotiating lower rates, consolidating debts, increasing income, and automating payments to prevent late fees. Investment planning is crucial for wealth accumulation. Understanding asset classes and risk return relationships forms the foundation. Strategic asset allocation and rebalancing are key to building diversified portfolios. Effective retirement planning involves assessing needs and selecting appropriate savings vehicles. Tax efficient investing minimizes tax impact, enhancing net returns. These strategies collectively pave the way for financial growth. Investment fundamentals are crucial for financial growth. Grasp the characteristics, risk profiles, and potential returns of various asset classes. This knowledge empowers you to make informed decisions, aligning investments with your financial goals and risk tolerance. Explore key investment vehicles and their role in a comprehensive wealth building strategy. Understanding investment fundamentals is crucial. Each asset class, from stocks to bonds, has unique characteristics, risks, and returns. Grasping these basics helps align your decisions with financial goals and risk tolerance. Explore key investment vehicles to build a comprehensive wealth strategy. Stocks represent ownership in companies, offering growth and dividends but with higher risk. Bonds are debt securities providing regular interest, stabilizing portfolios. Mutual funds and exchange-traded funds offer diversification. Exchange-traded funds trade like stocks. Real estate includes physical properties and real estate investment trusts, providing income and inflation protection. Alternative investments like commodities and hedge funds enhance diversification for sophisticated investors. The risk-return relationship is a key investment principle. Conservative options like savings accounts and government bonds offer security but limited growth. Corporate bonds and diversified funds present moderate risk and return. Higher risk investments, such as individual stocks and alternatives, promise greater returns but with increased volatility. Your position on this spectrum should align with your time horizon and financial goals. Defining investment objectives is crucial. Growth focuses on capital appreciation, accepting volatility for long-term gains, ideal for those with longer horizons. Income prioritizes regular cash flow through dividends and interest, suiting those nearing retirement. Capital preservation protects principal with modest returns, suitable for risk-averse investors. A blended approach often best reflects individual circumstances. Active investment strategies involve professional managers aiming to outperform benchmarks, offering potential market-beating returns and tactical market adjustments. However, they come with higher fees and no guaranteed outperformance. Passive strategies track indices, providing lower costs, consistent returns, and tax efficiency, but lack flexibility and downside protection. Research shows passive strategies often outperform active ones over time due to lower costs. Portfolio construction involves strategically combining assets to align with your financial goals. Asset allocation, distributing investments across asset classes, is crucial, influencing 90% of portfolio performance. Balancing risk and return while maintaining diversification is key to building a resilient portfolio. This approach ensures your investments are tailored to your objectives, enhancing long-term success. An investment policy statement, IPS, is your personalized investment roadmap, detailing financial goals, risk tolerance, and time horizon. Define objectives like retirement or education funding, assess risk comfort, and set asset allocation targets. Establish rebalancing rules and performance benchmarks to maintain discipline and ensure alignment with long term goals during market volatility. Strategic asset allocation sets a long term target mix, like 60% stocks and 40% bonds, maintaining consistency through rebalancing. It offers discipline, lower costs, and tax efficiency. Tactical allocation allows temporary shifts to exploit market opportunities, enhancing returns and managing risk, but demands expertise and incurs higher costs, ideal for sophisticated investors or those with professional guidance. Diversification is essential for risk management. By investing across asset classes, sectors, and geographies, you mitigate the impact of poor performance from any single investment. Geographic diversification reduces country specific risks, while sector diversification avoids concentration in cyclical industries. Asset class diversification balances risk return profiles, and time diversification through regular investing smooths market entry points, reducing timing risk. Rebalancing strategies are crucial for maintaining your target allocation. Time-based rebalancing involves adjusting your portfolio at regular intervals, while threshold-based rebalancing responds to market movements. A hybrid approach combines both, offering discipline and tax efficiency. Always consider transaction costs and tax implications, especially in taxable accounts, to optimize your rebalancing strategy. Retirement planning is crucial for financial security. Begin by assessing your needs and understanding savings options. Maximize contributions and project future expenses accurately. Early and consistent contributions leverage compound growth, significantly impacting your retirement fund. A robust strategy ensures a comfortable retirement, adapting to longer life expectancies and changing pension landscapes. Determine your retirement age and desired lifestyle. Consider relocation, hobbies, and part-time work. Anticipate healthcare costs and legacy plans. Calculate your retirement number. Aim for 70 to 80% of pre-retirement income. Use the 4% rule for withdrawals. Example: needing $25,000 annually from savings requires a $625,000 portfolio. Consult a financial planner for personalized advice. Workplace pensions, akin to 401ks, offer automatic payroll deductions and employer matching, reducing taxable income. Traditional individual retirement accounts allow tax-deductible contributions with tax-deferred growth, while Roth individual retirement accounts provide tax-free withdrawals. Simplified employee pension. Individual retirement accounts suit high earners with variable income, and savings incentive match plan for employees' individual retirement accounts benefit small businesses. Traditional pensions offer guaranteed income, though rare in the private sector. Strategically plan contributions to maximize retirement savings. Capture your full employer match, typically 3 to 6% of salary, for an immediate 100% return. Prioritize tax-advantaged accounts contributing up to $60,000 annually. Consider Roth conversions in lower income years for tax-free growth. Increase contributions with salary rises and utilize catch-up contributions if over 50. Estimate retirement expenses by categorizing them. Essential expenses like housing and healthcare should be 50 to 60% of your budget. Discretionary expenses such as travel should be 25 to 35%. Plan for healthcare costs, which may rise with age. Income sources include state pension, personal pensions, rental income, and part-time work. Adjust for inflation and lifestyle changes, ensuring a buffer for unexpected costs. Taxes can erode investment returns, reducing a 7% return to 5% after taxes. Tax-efficient investing involves structuring your portfolio to minimize tax drag while maintaining your risk-return profile. Understand investment taxation and use tax-advantaged accounts to enhance long-term wealth accumulation. Explore strategies to keep more of what you earn. Investment income is taxed differently. Short-term capital gains are taxed as ordinary income, while long-term gains enjoy lower rates. Qualified dividends are taxed like long-term gains, but ordinary dividends and interest income are taxed at your marginal rate. Consider holding high dividend and interest-generating investments in tax-advantaged accounts to optimize tax efficiency. Place tax-inefficient investments like bonds and real estate investment trusts in tax-advantaged accounts. Use tax loss harvesting to offset gains and reduce taxable income. Prioritize contributions to pensions and individual retirement accounts for tax deferred growth. Always balance tax strategies with sound investment decisions and consult professionals to adapt to changing tax laws and personal circumstances. Estate planning is crucial for safeguarding legacies. Key documents include wills, trusts, and powers of attorney. Tax considerations and wealth transfer strategies are essential for minimizing liabilities. Business succession ensures continuity for entrepreneurs. Regular monitoring adapts plans to life changes and market shifts. Understanding cognitive biases in financial decisions and adhering to ethical standards are vital for fiduciary duty. Estate planning is crucial for ensuring clients' wishes are respected, assets are distributed as intended, and tax burdens are minimized. It prevents legal complications and financial strain, providing peace of mind and security. Effective planning addresses wealth distribution, healthcare decisions, guardianship, and business continuity, evolving with life changes to align with clients' goals. Estate planning is crucial for ensuring clients' wishes are respected, assets are distributed as intended, and tax burdens are minimized. It prevents legal complications and financial strain, offering peace of mind and security for future generations. Advisors play a key role in protecting legacies and maintaining strong client relationships through evolving plans. Key estate planning documents include the last will and testament, which specifies asset distribution and guardianship. Trusts such as revocable living trusts avoid probate, while irrevocable trusts offer tax benefits. Power of attorney ensures financial decisions are managed if incapacitated. Living wills document medical preferences, preventing family disputes, and ensuring wishes are respected. Probate is a court-supervised process settling a deceased's estate, validating wills, appointing executors, and distributing assets. It can last 6 to 18 months, incurring costs of 3 to 7% of the estate's value. Assets are frozen, and the process is public. Strategies like living trusts and joint ownership can help avoid probate delays and costs. Beneficiary designations on accounts like individual retirement accounts and life insurance bypass probate, directly transferring assets to named individuals. Key accounts include retirement plans and investment accounts with transfer on death provisions. Avoid common mistakes. Update designations after life changes. Use trusts for minors and ensure alignment with your will. Regularly review every 3 to 5 years. Estate taxes impact wealth transfer upon death, with federal taxes applying to estates over $13.61 million in 2024. States may have lower thresholds. Key strategies include annual gifting within $18,000 limits, charitable contributions for tax efficiency, and using irrevocable life insurance trusts to exclude proceeds from taxable estates, preserving wealth for beneficiaries. Business succession planning is crucial for continuity and preserving value. It involves assessing goals, roles, and readiness, determining business value, and choosing a succession strategy. Implementing the plan requires monitoring outcomes and addressing leadership transition, ownership transfer, tax implications, and stakeholder interests. Effective planning typically spans 3 to 5 years, ensuring a smooth transition and safeguarding wealth. Internal succession involves transferring ownership to family or key employees, preserving culture and continuity, but may cause family conflicts and require training. External succession, selling to outsiders, often yields higher sale prices and liquidity, but risks losing family legacy and altering company culture. Each strategy has distinct advantages and challenges. Accurate business valuation is crucial in succession planning. Appraisers use asset-based, income-based, and market-based methods. Regular updates are essential, especially before transitions. Transfer structures include gradual gifting, installment sales, family limited partnerships, employee stock ownership plans, management buyouts, and strategic sales. Each offers unique benefits and challenges, impacting control, tax implications, and business continuity. Financial planning demands continuous monitoring and adjustments. Systematic reviews ensure plans align with evolving life circumstances, market changes, and personal goals. Quarterly reviews focus on investment performance, while annual reviews cover comprehensive financial plans. Major life events and market volatility necessitate reassessment of risk tolerance and strategies. Regular reviews significantly enhance goal achievement likelihood. Career transitions demand revisiting income projections and retirement contributions. Family milestones like marriage or divorce require updates to beneficiary designations and estate documents. Health changes necessitate adjustments in insurance and healthcare planning. Economic shifts, such as interest rate changes, call for strategic investment allocation reviews to maintain alignment with financial goals. Effective financial planning hinges on quantifiable metrics. Establish clear benchmarks to track retirement savings, education funding, debt reduction, and emergency fund adequacy. Compare portfolio returns to benchmarks, assess risk adjusted performance, and monitor asset allocation. Evaluate insurance coverage, diversification, and liquidity reserves. Analyze cash flow trends, spending patterns, and debt to income ratios to ensure alignment with financial priorities. Advisors play a crucial role in ongoing plan management by maintaining proactive communication, offering market updates, and educational content. They assist in scenario planning, coordinating with other professionals, and providing behavioral coaching to manage emotional reactions. Identifying opportunities like tax loss harvesting and utilizing technology enhances transparency and efficiency in managing clients' financial plans. Behavioral finance highlights how cognitive biases like anchoring, loss aversion, and herd mentality impact investment decisions. Anchoring leads investors to fixate on initial prices, while loss aversion causes reluctance to sell at a loss. Herd mentality drives following the crowd, often resulting in buying high and selling low, contrary to rational investment strategies. Confirmation bias leads investors to seek information that supports their beliefs, ignoring contradictory evidence. Recency bias causes reliance on recent events, skewing decision making. Overconfidence results in excessive trading and poor diversification. Mental accounting treats money differently based on its source, affecting risk perception. Recognizing these biases is crucial for informed investment decisions. Recognizing patterns in cognitive biases is crucial for investors. Establish clear, rules-based decision processes to mitigate these biases. Regularly seek objective counsel from advisors to maintain perspective. Focus on long-term goals and discipline, ensuring decisions are based on strategy rather than emotion. Successful investors combine awareness with systematic approaches to navigate market challenges effectively. Developing financial discipline involves pre-commitment strategies, like setting investment policies during calm periods, automatic execution through systematic contributions, and rebalancing minimizes emotional influence. Cooling off periods prevent hasty decisions, while diversification discipline ensures broad asset allocation. Emotional intelligence is key, requiring awareness of emotional responses and objective decision reviews to balance analytical rigor with emotional control. Ethics are crucial in financial planning, ensuring trust between advisors and clients. Advisors must prioritize client welfare, adhering to fiduciary duty by placing client interests first and disclosing conflicts. Confidentiality is paramount, with strict standards set by professional bodies. Violations can lead to severe repercussions, emphasizing the importance of ethical conduct in maintaining professional integrity. Estate planning is crucial for safeguarding clients' intentions, reducing tax liabilities, and avoiding family disputes. Regular updates ensure plans adapt to life changes and legal shifts. Business succession demands early planning for seamless transitions, maximizing value. Financial plans require constant attention to stay relevant. Recognizing behavioral biases aids advisors in steering clients away from emotional decisions. Ethics underpin every client interaction, ensuring trust and integrity.